Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us by GreenTraderTax. We're very pleased to have Robert Green, Managing Member of Green, Neuschwander and Manning, and CEO of GreenTraderTax, joining us here today. Robert, thank you for joining.
Thank you, Cynthia.
I'm going to go ahead and pass you the controls so that we can get started.
Thank you. And let's get started. Traders have unique issues for year-end planning. Today is December 5th, 2018. We're going right into the year-end. There's a lot of articles in the financial media with excellent year-end planning tips, but I always think they're more plain vanilla. Traders have unique issues. For example, most media will say, pundits will say, wash sales are always bad, but in some cases, they can be good. You can turn them into an ordinary loss in the next year. That's a nuance that traders face that investors may not. So thank you for introducing me, Cynthia. I'm considered a leading authority on trader tax. I have Green's 2018 Trader Tax Guide, written every year for 20 years, includes the latest tax cuts bill. I'm just about finished writing the 2019 guide that will be released in early January. If you get the 018, it comes with 019. I'm a contributor to Forbes, the financial media, on many webinar platforms. This information is educational. It's not intended to be specific one-on-one advice. You should get that for year-end planning before year-end. I'm not affiliated with Interactive Brokers. I'm just doing this webinar and others. While the latest tax bill did not change trader tax status 475 and wash sale rules specifically, there's a lot to consider. Now, this is sort of a part two. We did how traders can save taxes before year end, focusing on the latest tax bill, act, a month ago, and you can watch that recording. So you're going to learn even more items that are unique to traders in this session. One in particular as a highlight is a lot of traders with trader tax status set up S-Corps in 2018 to get additional tax benefits. Well, they need to execute year-end payroll to unlock the 2018 health insurance and retirement plan deductions. Now, if you missed the boat for 2018, you're going to learn how you can set up an LLC now in December to be ready to trade as an S-Corp on January 1st, so you get those benefits for all of next year. Let's start with how to avoid wash sale losses. Now, you don't want to get stuck with a higher tax liability caused by deferring wash sale losses to 2019. So if you take a loss today, and you're flat, you have no positions going into year end, and you buy back that losing position January 2nd, that's less than 30 days. The IRS is going to say it's not really an economic loss, which I don't buy that, but they're going to say it's not really an economic loss. You just sold it for a tax benefit and you got back into the position. So we're not going to let you take the loss in 2018. We're going to make you defer that loss to 2019. So you went about tax loss selling to lower your tax bill and the IRS didn't buy it. And that would be unfortunate. So it's more complicated than that, unfortunately. You should know the wash sale loss rules that apply to securities, not the 1256 contracts like futures, but to securities. Securities traders must comply with these rules, but the IRS makes it difficult by applying different standards for taxpayers versus brokers on tax reports and 1099-Bs. So you're working with your broker now. You're looking at the online tax reports, and you're trading stocks and stock options, and you're saying, and you have a couple of different accounts that are taxable and a couple of different IRA accounts with you and your spouse. You file jointly. And you're looking at those reports and you're saying, you know something, I don't think I have a wash sale problem. I'm okay here. I'll take a loss on this one account. I'll buy it back in the other account. I'll sell the December option. I'll buy back the January option. and you have false readings. You think you're okay when in fact you're not okay, assuming you're going to follow the IRS rules for taxpayers, and not everybody does. A lot of local CPAs and taxpayers are unaware of these rules, and they're basically speeding down the highway without seeing the speed limit sign. And will the cops, the IRS, bust them or not? It remains to be seen. But I think you should do it properly based on the rules for taxpayers. So taxpayers must report wash sales on substantially identical positions. That means Apple stock, Apple December options, Apple January options. Those are all substantially identical across all accounts on their individual level. Whereas brokers only report identical positions, just the Apple stock, just the Apple December option on the one account. You can imagine that one broker is not going to communicate with another brokerage firm. Now, if you want to do it properly, which I encourage you to do, you should get a trade accounting program or a service and identify potential wash sale loss problems going into year end. A program like TradeLog has a potential wash sale loss report, and it can spot those wash sales based on the rules for taxpayers, and you can avoid it. You can break the chain by selling the positions before year end and not replacing a substantial identical positions 30 days before or after in any your taxable IRA account. So if the markets are moving based on risk on, risk off, when you look at the indices and various related positions, they're moving similarly. So if you get out of tech stock A, maybe you get back into tech stock B, but not A, or a similar index for the S&P 500 or ETF. Remember, the broad-based index is 1256. That's mark to market. There are no wash sales. Now, if you happen to start a new trader tax status entity on January 1st, that's going to break the chain, because you're going to stop trading in the individual account at the end of December and resume trading in the S-Corp, the LLC/S-Corp, on January 1st, 2nd. And that's also going to avoid wash sales. Now, if you purposely get back into a wash sale position, the IRS could argue that that's a related party and it was to avoid wash sales. But you can fix that with a 475 election in the entity, which is probably what you may want anyway. There's a lot of nuances here, folks. We're going over the basics. Now, it's very important to avoid wash sales between taxable accounts and IRA accounts, including Roth IRAs, throughout the year, as that is otherwise a permanent wash sale loss. Now, if you just have a taxable account and you have a loss in December, and you say, I'm not going to buy it back for 30 days to avoid the wash sale, but there's a huge rally in early January and you don't want to miss it. So you say, I'm going to get back in. So what? I have a wash sale in December. We'll defer the loss to January. It's only a deferral. I want to catch the wave. That's okay, but you don't want to do it with an IRA account, because then it's a permanent, not a deferral, a permanent wash sale where you can't deduct it ever in the taxable account, and there's no way to record the loss with a higher basis in your IRA, so you're permanently disenfranchised. That's catastrophic. A lot of traders and investors still don't understand that. They need do not trade lists between the IRA and taxable accounts. Trade tech stocks taxable and not tech stocks in the IRA. Now, there are ways to convert 2018 wash sale losses into 2019 ordinary losses. Remember, what you want to avoid is having a big capital loss carryover. So you can have a capital loss during the year, and they're unlimited against capital gains. So you make 100,000 in winning positions, you lose 110,000 in losing positions. You can write off the 110 against the 100. You have a net loss of 10,000. That is limited to 3,000 against other income like wages, and then you carry over 7,000 to the next year. But what if that carryover is 70,000? What if it's 700,000? This can happen to bigger traders. It happened with the dot-com crash in 2000. It happened with crypto last year. And people get stuck for many, many years having to use up capital loss carryovers. That is the number one pitfall for investors and traders, and something I'm trying to help you avoid. So what would you rather have? A $200,000 capital loss carryover or a $200,000 wash sale loss deferral? You want the latter, because the latter you can turn into an ordinary loss in the next year under certain conditions. So wash sale losses might be preferable to capital loss carryovers at year end. A Section 475 election in 2019 by a trader tax status TTS trader converts year-end 2018 wash sale losses on TTS positions, not on investment positions, into ordinary losses in 2019. So you're going into year-end, you see that you have a capital loss carryover. So if your capital loss carryover is 100,000 and you're going to have wash sales at year-end of 50,000, that's okay. You're still going to have a capital loss limitation of 3,000. But you have a chance to convert that 50,000 wash sale into an ordinary loss with a 475 election in 2019. So you actually do want to get back into those positions in January for wash sale loss reporting. So that's better than a capital loss carryover into 2019, which can never be converted to an ordinary loss and may give you pause to making a 475 election. Remember, the bigger your capital loss carryover is going into next year, the more you want to hold off maybe on a 475 election, because 475 is ordinary income and loss, ordinary loss. You always want to have a clean slate. You don't want a capital loss baggage. You don't want a big hole. You don't want to have a big hole of capital losses, because you need a capital gains ladder to climb out of the hole. But in order not to dig a bigger hole, you need a 475 election. So you need to know what your situation is going into next year, what happens in Q1, and to make the right decision about 475. So many people get this wrong. It's so nuanced, and there's so many pitfalls. I don't want to lose you on this in the weeds, but this is a big thing, because the worst thing for a trader is to have all this ordinary income, but you can't deduct your losses. That's so unfair. That 3,000 capital loss limitation, it was never indexed for inflation. That is unfair. Now, once you have, it's not just your capital loss carryovers that matter. When I consult clients, I ask them about what are your unrealized capital gains and losses. Because if you're sitting there with a large unrealized capital loss, I know that eventually you need capital gains to use that up. So again, it gives pause to a 475 election. So if you elect 475 on securities for 2019 by March 15, 2018, as an existing trader tax status trader, then unrealized gains and losses at year-end 2019 on TTS positions are a 481A adjustment. So if you're sitting on some unrealized losses at year-end, and you're a TTS trader now, and you're thinking, should I sell them before year-end? Now, I mean, if you're holding positions between now and year-end, they may be investment positions. A lot of active traders don't have large unrealized gains and losses like day traders or swing traders, but you may have some. They're part of a 481A adjustment, which is an ordinary gain or loss on January 1st. It's another way to convert unrealized capital losses into ordinary losses. So again, capital loss carryovers are the worst outcome. How can you avoid that? How can you get a wash sale that you can convert to an ordinary loss? How can you have an unrealized loss converted to an ordinary loss with the 475 election? So that's what I'm talking about today with wash sales. And you're not going to get that in reading the tax tips from the Wall Street Journal or the AICPA or the other leading media. You'll get great tips, which I have in all our content too. But that was a little bit of uniqueness for the trader. All right, so let's talk about the tax loss selling, which I think is very interesting. I mean, the markets are whipsawed now with volatility. There's been a long bull run. A lot of people think, well, it's getting tired. The economy may slow. Everything's been great. Will the markets sell off? Is it a bear market? Is it a bull market? Short covering? Who knows? I'm not an investment advisor. But a lot of people are taking profits now. A lot of them are doing tax loss selling. They've had they took some big profits because they saw that maybe the FANG stocks were rolling over and they wanted to take some profits, and they got some big tax bills that they're accumulating for 2018. And they're looking at their portfolio and seeing, well, I got a couple of losers here too. Let me sell those to reduce my capital gains. So should you sell open positions before year end? Don't have the tax tail wag the dog, folks. Make investment decisions that are prudent based on your thinking and research and counsel with investment advisors. Not me. I'm not an investment advisor. All I want to do is point out some of the taxes. If you own an investment portfolio, you have the opportunity to reduce capital gains taxes via tax loss selling. You may wish to sell winning positions too, tax win positions to accelerate income. Now, if you have a capital loss carryover, it'd be nice to get rid of that or trim the sales on that so you can get into 475 next year. So this is the opposite of tax loss selling. It's tax win selling. If you have an NOL, maybe you want to use it up and take advantage of the standard deduction and even take advantage of the 0% long-term capital gains rates on the lowest two ordinary brackets. So it's not just about tax loss selling, it's about tax win selling. You want to have that clean slate, meaning no capital loss carryovers to elect 475 the next year. Now, if you do the tax loss selling, you realize you have significant short-term capital gains year to date. I've done a lot of consultations like this. Someone's up 300, 400, 500. They have some open positions with unrealized capital losses. They were waiting for those positions to maybe turn around or to correct. They should consider selling some of those losses to reduce the 2018 capital gains taxes. Just don't get back into a substantially identical position in any of your accounts, including the IRAs, because that will be a wash sale loss and negate the tax loss selling. Now, let's say you left a job in 2017 and you're a trader in 2018 and you have a losing year or a flat, and with the standard deduction and some of the other things, you're in the lowest two brackets. You're under 38,600 single or 77,200 married on your taxable income. Maybe your spouse has a part-time job but not making a lot of money. A lot of traders fall into this category in some years. Well, there's a zero rate on long-term capital gains. So for example, you're single, your taxable income is $30,000. You can do tax winnings on long-term capital gains where you've held the position 12 months. You can realize $8,000 of gains and have zero federal tax. You may have state tax rates that apply, but zero federal tax. Now be careful. If you sell $10,000 of gains, that will make the whole thing taxable at the 15% rate. So it's sort of like a fiscal cliff. You got to do your tax planning carefully. Now, Good tax planning requires year-end pro forma tax returns. Who wants to prepare a tax return based on incomplete information just before the holidays in December? That's a tall task. A lot of sophisticated taxpayers do it. It's not that easy. But you may have a good handle on your bookkeeping, on your trading gains and losses using trade log, or you know where you stand. Now, the IRS is not going to let you game the system. They have various rules to prevent deferral of income. They have, if it's, for example, on offsetting positions that lack substantial or sufficient economic risk. That includes straddles, the constructive sale rule, shorting against the box. So you can't say, I got offsetting positions here. I'm flat, basically, but I'm going to sell the loser, but keep open the winner. And there's all sorts of scenarios and different schemes that people have tried over the years to do that. And the IRS has all sorts of rules to prevent that. So just know, if you have offsetting positions that lack sufficient economic risk, you're probably going to be not able to game the system. But that's beyond the scope of today's webinar. And be aware of constructive receipt of income rules too. So if you get paid, if someone hands you a check for income or offers to pay you, like a prop trader who's a 1099 miscellaneous, and they have a monthly return, they say, do you want the check or reinvest it? You say reinvest it. You're turning your back on that income. That's constructively as if you received the income, and the IRS is going to tax you on it. Now, tax loss selling is not always needed, because tax loss selling is inefficient for short-term positions that reduce long-term capital gains rates. So if you have a long-term capital gain at the 0 rate, if you have it at the 15% rate, which is everything above the 0 rate except for the top rate, which is 20%, you may say, hey, that's not bad. Let me get that 15% rate. I don't mind paying that rate. Next year it could be, it could be worse. It could be, the position may decline in value. So if you have a long-term capital gain as of last week, before that position maybe corrects, and I'm not saying it will, but if you want to sell it now and you are waiting for the long-term gain, then maybe you take it now. Now, you always want to see what's in the short-term bucket, what's in the long-term bucket, how it all works out. But in the end, it's all consolidated on Schedule D. But it depends on what rate you're using, short-term or long-term. But short-term losses can reduce long-term gains and vice versa. Now, tax loss selling is also a moot point when it comes to mark-to-market accounting, whether it's Section 1256 futures, broad-based indexes, non-equity options, or you're a TTS, trader tax status trader, and you elected 475 MTM. You're going to be paying taxes on realized and unrealized gains and losses. So you don't, on TTS positions, not on segregated investment positions. So you don't need to sell if you like being in a position. But again, TTS positions are not segregated long-term investment positions. Let's talk about trader tax status and then move away from the WAR sales and the capital losses. Now we're talking about trader tax status when you qualify 4 trades a day, 4 days a week, 15 trades a week, 60 a month, 720 a year, day trading, swing trading, 4 hours a day. We've covered that in prior sessions. This is being in the business of trading. So you get business expense treatment. No election is needed for trader tax status. If you didn't know about it earlier in the year, that's okay. You can still claim and use it. Just add a Schedule C to your tax return. If you have trader tax status going into this year end, you're not sure whether you're going to have it next year. You probably want to accelerate trading expenses. If you're going to get a new computer system, buy it and take delivery and put it into service before year end. It's not enough to just put it on your credit card on 12/31. You got to receive it and put it into service, and then get 100% write-off with very lucrative liberal expensing rules under the new tax bill, the Tax Cuts and Jobs Act, TCJA, the tax law. So now on the other hand, If you know you don't qualify in 2019, you didn't qualify as of early Q4, trading actively in December is not enough to claim it for 2018. So you know your trader tax status starts in January of 2019. Then maybe defer some expenses. Now remember, when you start your trader tax status, you can capitalize and amortize startup costs, Section 195, organization costs 248. So if you had education with a trading school in July and August of 2018, and you start your trader tax status January 1st, we allow you to go back 6 months, a reasonable time frame, 6 months, which is to July 1st, to capitalize education as a Section 195 startup cost, and then amortize expense up to $5,000 on your 2019 tax return, the rest over 15 years. The same for organization costs, like including paying, attorneys and accountants for help forming your LLC. Now, the TTS is a prerequisite for electing the 475. So you can have TTS in January as a sole proprietor, as a partnership, or as an S-Corp. And any of those can elect 475 in 2019. The pass-through entities by March 15th, the sole proprietor by April 15th. So TTS traders choose 475 on securities for exemption from the wash sale loss rules, so you don't have to deal with all that wash sale hassle that we talked about earlier. It's an exemption from wash sale loss rules. It's an exemption from the 3,000 capital loss limitation. It's too late to elect it for 2018, but you can think about this election for 2019. But again, if you have a capital loss carryover, it gives you pause. You have to evaluate it more closely. Another benefit is perhaps a 20% qualified business income deduction, QBI deduction under TCJA, the new tax law, if you're under the taxable income cap for a service business. So again, existing individuals will elect 475 by April 17th. They had to do it by April 17, 2018 for 018, or March 15th for 018. If you missed the election for last year, this 2018, you want to consider the election for next year, but again, you need to carefully assess it if you have the capital loss carryover. So if you do set up a new entity for 2019, it must elect within 75 days of inception. So if you form the entity in April, so let's say you're trading Q1 as a sole proprietor, make a decision about 475 or not, and then have a do-over with an entity on April 15th, then the entity has 75 days. All of that rationale is covered in my guide in the chapter on MTM. It's too late to form a new trading entity for 2018. You had to do that by no later than early November, because November and December is not enough of a period to impress the IRS for TTS. Now, once you elect 475, it's going to apply in all subsequent years as long as you have the TTS, unless you revoke it. Now, one of the nice things about 475 is, again, the tax loss insurance, the ordinary losses. There is no capital loss limitation. You lose $300,000, that's an ordinary loss. Your business expenses, ordinary loss. Now, unfortunately, under TCJA, the new tax law, NOLs are carried forward only, and they're limited to 80% of taxable income. That's unfortunate law change. In 2017 and prior years, the NOL could be a carryback 2 years and get rid of taxes. I'm going to tell a story about that later. But you can get immediate use of NOLs if you do a Roth IRA conversion, a backdoor IRA. You don't have to just worry about contributions into a Roth. You could take a Roth of $200K, convert it into a Roth IRA, offset with the NOL, pay no conversion taxes, and then that Roth IRA is permanently tax-free for life. So if you think the markets have corrected a bit now might be a time to convert into a Roth IRA at a lower price. So when the markets recover, they recover inside the Roth permanently tax-free. Maybe not this year, maybe you'll do it next year. But whenever, if you feel that the bull market is on its last legs. Now, the new tax law, TCJA, introduced the excess business loss, the EBL limitation, 500 married, 250K other taxpayers single. You aggregate EBL from all pass-through businesses, so a profitable company can offset a losing business. So the EBL is an NOL carry forward. For example, if a single TTS trader with 475 has an ordinary loss of 300, wait, that's limited to 250 as an EBL, so the EBL is 50. So you get the 250 loss this year to offset your wages, your spouse's wages, your other income. You couldn't use that other 50 this year. You carry forward that other 50 to next year where it offsets your wages or your spouse's wages or your trading gains. Now, let's talk about the entities. And let me take a quick drinking break here for some water. Let's see how we're doing on time. We're doing good. Now it's time to take care of business this time of the year for an existing S-Corp. You have an S-Corp for 2018. There are several vital transactions to execute before year end. TTS traders use an S-Corp trading company, not a sole proprietorship, not a partnership, the S-Corp, to arrange the health insurance deduction, so it could be a big deduction, and the retirement plan deduction, the biggest deduction for traders. They have the option to do a little bit for retirement or a lot, and you want to make that decision now in December. It's all part of executing officer compensation in conjunction with these benefits through formal payroll compliance before year end. So our clients work with us and we bring in our representatives at Paychecks and we do a December payroll. We haven't done the payroll all year. We know that we're going to do reimbursement of health insurance for the period the entity was open in 2018 in the December payroll at a minimum. And if the entity is profitable, and we don't know that until early December, you could have had big gains in Q1 and Q2, but lost it in Q3. We want the visibility going into year end. If you're profitable, we may be doing a large or a less significant retirement plan deduction. It's up to you. This is all going to happen now for the 2018 year. The TTS is an absolute must, since an S-Corp investment company cannot have tax-deductible wages. The TCJA tax law suspended that deduction. Investment company can't have wages, can't reimburse health insurance, can't have retirement plan deductions. It's another reason we wait until December to see what happened for the year with your TTS. So let's talk about that health insurance deduction, the retirement plan deduction, and the QBI, qualified business income deduction. The S-Corp may only deduct health insurance for the months the entity was operational and qualified for TTS. So let's say you set up your S-Corp July 1st. You're not going to deduct the health insurance for Q1 and Q2. It's only for Q3 and Q4. So it's for the period that you had TTS. The health insurance component of officer wages is not subject to payroll tax. So let's say you had the entity for the full year. Your health insurance for you and your family was $20,000 or $25,000. You're going to put that on officer comp. It's not subject to payroll tax. That's the deduction. Then you report the wages on your individual return. You take the health insurance deduction on your individual return. It's a little tricky, but the bottom line is you get the $20,000 health insurance deduction with no offsetting payroll tax. Slam dunk, great move, justified having the S-Corp for the year. You save $8,000 in taxes, less or more. It really pays all the bill of the tax compliance for the S-Corp and the payroll compliance, which costs about $600 with paychecks. The federal unemployment insurance is about $50. In almost all states, you're exempt from state unemployment insurance and workman's compensation. Great move. Now, an S-Corp form later in the year can unlock a retirement plan deduction for the entire year by paying sufficient officer compensation in December when the results for the year are evident. So you had it in January, you had it started in July, you started October 1st, but you made enough money in the S-Corp to maximize the retirement plan deduction. Another reason to create the compensation is to create the potential 20% QBI deduction if you are in the phase-out range. This is a little trickier. You are over the threshold, but under the income cap, you're in the phase-out range. There's a wage limitation. You need some wages for that too. But you have the wages for retirement and health insurance. So one hand helped the other. Now, sole proprietors and partnerships are out of luck here, folks. That's why we've advocated the S-Corp. TTS traders organized as a sole proprietorship, which is an unincorporated business. They cannot have the health insurance and retirement plan deductions because they don't have self-employment income from trading income, unless you're a full-scale member of a futures exchange, trading futures on the exchange. So otherwise, they don't have SEI. They don't have trading income. They can't create earned income. Now, a partnership, they can attempt to pay some earned income with paying administration fees or a guaranteed payment, but it doesn't work because the partnership passes through all that fees as losses, which drain the water of the SEI. It drains the glass. You can't get SEI, so you can't do it. The S-Corp doesn't pass through the expenses, so the S-Corp works, the partnership doesn't. So you've done the health insurance. Now, the health insurance, by the way, doesn't include COBRA or any sort of employer-provided insurance. So if you leave your job and you go on COBRA for 18 months, you're not going to be able to deduct that. It's got to be individually or group related for your company or individual for your family, or even Medicare supplemental. But if it's employer provided, you're a retiree of a great company with great benefits, and it provides retirement and it provides health insurance in retirement. That's employer provided, not deductible. Now let's talk about the retirement plan. This is where there's a lot of savings. Uncle Sam, the IRS, and state are going to pay you several $1,000s incentive money to save for retirement. And then that retirement account is tax-free until you take the money out in retirement. Or you forego the tax deduction, go into a Roth plan, a solo 401k Roth, and it's permanently tax-free in retirement, both the contributions and the growth. And you can pass that benefit to your heirs too. So this is an important set of financial planning and tax planning. The solo 401k, otherwise known as the individual 401k, is the best plan for traders for the TTS S-Corp, and you gotta set this plan up. You gotta open it up with the financial intermediary before you're in. You don't have to put in any money necessarily, but you gotta paper it up. You gotta open it up. A SEP IRA, you can wait until the due date of your return, including extensions. And if you miss this deadline, maybe that's what you'll do. But you can do a lot more for less with the solo 401k. So there's two elements to it. There's an elective deferral. This is where the main tax juice is. This is what you want to focus on first for you, and perhaps for your spouse if your spouse works in the entity as well, because this is 100% deductible. So you want to plan to pay the 2018 elective deferral, ED, up to a maximum amount of $18,500. And if you're over age 50, the $6,000 cash provision takes you up to $24,500. You're going to need to execute this with your December payroll that you're doing now this month. The elective deferral payment has to be paid by January 31st. So it's on your W-2 for 2018, but you have to pay it in, you have to fund it into the plan by January 31st because it's December payroll. The elective deferral portion is 100% tax deductible, so you only need wages of that amount. Now, that portion of gross wages is subject to payroll taxes, which is your 12.4% FICA up to the SSA limit of $128,400. After that, if you have wages above that to maximize the plan, there's no more FICA, but there is the 2.9% Medicare tax. That's unlimited. So that's the cost. But the tax deduction is greater than the cost. So with a tax deductible plan, the income tax savings, federal and state, should exceed payroll tax costs. Now, if you didn't make much money and your federal rate is lower than the payroll tax cost, and you're in a tax-free state, then maybe you won't do it. Or maybe you'll do the Roth, where you sacrifice a deduction to have a permanent tax-free status of both the contribution and the gross. So again, with the traditional, now let's say you have a solo 401k account from TD Ameritrade that allows a qualified plan loan and allows the Roth, or with Fidelity or Schwab or any of the major brokers that offer it. I'm not sure if IB does. So let's say that you're deciding, do I want a Roth or do I want a traditional? Well, the traditional, you get the tax deduction up front. That's nice. You get the income tax savings, could be at a 37% top federal rate, could be at a 8% state rate, depends on what state you're in. You may really want that deduction for some huge savings. But then it's tax-free until retirement age. At age 70 and a half, you have to take your required minimum distributions if you roll it over to a rollover IRA. And then you're going to pay taxes on those distributions, on all distributions in retirement. So it's a deferral benefit. With the Roth, it's a permanent benefit. The contribution, the growth, take the money out in retirement, tax-free. That's a wonderful way to enhance your retirement savings. So that was the elective deferral. That's what you focused on first. And again, you waited to see if you were profitable enough to have that much wages. If you made $30,000, fine, do your $18,500. If you make $100,000, you may want to do a little bit more with a profit sharing plan. So plan to pay the 25% deductible profit sharing plan up to the maximum of $36,500 for 2018. You don't have to pay that until September 15th if your S-Corp return is on extension. So you can do the officer compensation now up to a maximum of $146,000. So you made $200,000, you do payroll of $146,000, and you know you're going to fund $36,500 to the profit sharing plan, or that's what your plan is, and you don't have to part with that cash flow until September of the next year when you make the final decision working with your CPA firm on the tax returns. But you have to commit to the payroll now. You have to make the decision now about the payroll. Why pay $146,000 and have more payroll tax? And by the way, the employer's portion is 50% deductible of the employer's portion of the payroll tax, which is 50%, is 100% deductible. So, but why commit to $146,000 unless you're going to do that profit sharing plan max? So the total plan, both the elective deferral and profit sharing plan, is $55,000 for 2018, and with the $6,000 catch up, it's $61,000. So imagine with the S-Corp deducting $61,000, health insurance $20,000, $81,000 of deductions that the sole proprietor trader doesn't get. That's a huge savings. It's even better in 2019. The elective deferral limit goes up $500 to $19,000. The profit sharing plan goes up $500 to $37,000, $1,000 total overall. So it's $56,000 with a catch up $62,000. And the wages necessary for that profit sharing plan of $37,000 is $148,000. $37,000 divided by 25% is $148,000. So I got you lost in the weeds a little bit, but now it's time to execute the weeds. You sit down with your accountant, hopefully us. You tell us, this is what I made for the year. This is what my overall income is for the year and expenses. We do some tax year-end planning. How much do we want to contribute? Do we want to do Roth or traditional? What is your cash flow planning? What do you think you can part with? We go through all this. We make a decision. My partner, Adam Manning, CPA from Green, Neuschwander and Manning, is standing by to help our S-Corp clients with this year-end planning. Just sign up for it, schedule your meeting, and do it. Don't miss the boat. If you don't do the payroll, you missed the boat. Okay, you missed the boat. What can you do next? Well, set it up for 2019. Don't wait. Get it right from day one. If you want an entity for 2019, consider getting started now in December, working with me to be ready to trade on January 1st or in crypto or Forex, but otherwise when the first market opens, on January 2nd. The 2019 S-Corp formation process is something you want to think about now. So to get the employee benefits for 2019. So it's going to be beneficial to start from day one. That's going to break the chain on your wash sales. It's one way to avoid the wash sales at year end for 2019. You set up the entity, you make the S-Corp election. It's a nice clean break. If you start later, then you're going to have tax compliance as an individual for the first few months, and then you'll have the S-Corp. Now, that may be a good strategy for some people with these tricky 475 election moves where they have a capital loss carryover. You use it up in Q1 as an individual, get a clean slate, and then you set up the entity for Q2. So it depends. I'm not telling everyone to do it from day one. You want to consult with me about it. But let's say you want to start on January 1. Well, if you wait to form your entity on January 1, it's going to take a week or two. You're going to miss a couple of weeks. That could trigger wash sales on those first few weeks. It could have more complicated compliance. So I have a great nifty strategy for you. You form a single member LLC in December now. You get the employer identification number online. You open up the single member LLC entity brokerage account before year end. But the SMLLC is a disregarded entity. It taxed nothing for 2018, which means you don't have to file an entity tax return for the short period of the year. You want to make sure if there's a minimum tax, you avoid that. Like in California, if you form it after December 15th, there's no minimum tax. But it makes so much sense because then what you do next is if you want a partnership, you add your spouse as a member on January 1st in the operating agreement. So the partnership return starts January 1st. But if you want the health insurance and the retirement plan deduction, then your LLC should submit an S-Corp election for 2019 by March 15, 2019. So basically, the partnership or the S-Corp is started as of January 1st, but you are ready to trade as of January 1st. And you make a decision about the 475 on the entity level by March 15th. So we're doing a lot of those for people now. Now, let me tell you one story before we go to Q&A and see how we're doing on timing. We're doing good. Now, this year kind of reminds me, and, I'm a conservative accountant, a little bit, conservative in the markets, but it reminds me of the dot-com crash from 2000. Many investors, they sold open positions in late 1999 because they thought that a bubble was forming and they wanted to preserve profits. Maybe some of their positions were acting funny and they wanted to take profits. So they winded up owing substantial capital gains taxes for 1999. Now, some of them reinvested that tax money They didn't owe it with estimated taxes because they had made so much more money in 99 with that profit taking. So they figured, let me reinvest that tax money in early 2000, trading or whatever. And some of them incurred substantial capital losses when the markets crashed in March 2000, when the dot-com crash started. So these investors, they suffered from the 3,000 capital loss limitation in 2000. They had a huge tax bill in 1999, and they had this huge capital loss carryover in 2000 going into the years afterwards. And many of them took a decade to use it up. I worked with clients for years. Oh, I still have my capital loss carryover, because they lost a lot of their money and they couldn't make big capital gains. And then they had trouble paying their 1999 taxes because they took that tax money and had lost it. Now, we came in to save the day with our claim to fame, GreenTraderTax, when the IRS changed the law in 1997, saying that traders could use 475 and it was a free election to make. And I saw the markets were getting a little frothy. I went out on the internet and I spread the message, hey, elect 475. If this thing ever crashes, you want ordinary loss treatment, tax loss insurance. So in 2000, clients came to us. They qualified as traders. They elected 475 by April 15, 2000. And their 2000 losses were NOLs, and they could do an NOL carryback going 2 years back, which included 1999. So they owed the IRS a fortune for 1999, but the NOL carryback wiped it out. So when they filed their 99 return, they said, listen, I want a payment plan, but just so you know, I'm going to be carrying back an NOL to wipe this out. Now there's a problem this year because TCJA, the new tax law, repealed NOL carrybacks. So it's going to be harder to get immediate tax relief if this type of thing ever occurs in the future. Could be forming right now. A similar outcome happened with cryptocurrencies in 2017 and 2018. Traders had massive capital gains in 2017. They held on, the market crashed. They held their positions. They didn't pay the IRS. They owe the IRS. They were waiting for crypto to recover. It hasn't. And now they're in hot water. So that's just a story about, it's much more than about taxes. It's about markets. But in the end, it comes back to be very much about taxes. You need to think this out carefully for yourselves, sort of like a chess game. Consult with me if you want. I have plenty of appointments before year end. Next week, we have a nice Q&A session as well. But let's get to your Q&A questions now. And by the way, come over to greentradertax.com. Email your questions to info@greentradertax.com. I'm going to answer questions that you put up on chat now, but also we're going to answer questions next week's session. So check that out on our website and sign up for that. And then let's go over to the website. And let's get to your questions. So let me just bring that up. Questions. Let me expand that. I'm not going to read last names. You won't see the people asking the questions.
And Robert, while you're dealing with that questions panel, I do want to remind everyone, in the control panel over on the right-hand side of your screen, you'll find a questions title bar that you can simply double-click and then enter any questions that you might have for Robert at this time. We'll try and get to as many as we can as time allows. Okay, back over to you now, Robert.
Thank you, Cynthia. All right, so John G. asks, to declare trader tax status for 2019 and get an S-Corp for 2019, what is the deadline date to have these completed? You can start on the single member LLC with the S-Corp election for 1/1 now. You can wait until January, February. You can wait up until October. But when you form the entity and you open up the entity account with your broker, and with IB, higher professional data feed fee rates apply for an entity account. So check with them about those rates. When you do it, that's when the entity applies from that period going forward, not the earlier year period. So if you make a lot of money in Q1, 2, and 3 and don't form your entity till Q4, you can't look back at those earlier year profits. So the TTS is something you claim. You put the bread in the oven as a metaphor, pull the bread out of the oven, it either rose to be bread or it's flatbread without TTS. The 475 election, you have to file on time. A new entity files it internally. An existing entity files it externally with the IRS. So it's sort of like TTS is undergraduate school. You claim your diploma. You didn't have to apply, you just went. But grad school 475, you had to apply to on time, whether you even before you graduated with TTS, as a metaphor. James V. When you say across all accounts, does that include IRA accounts? Yes, it does. So you take a loss in a taxable account. You get back into a substantially identical position in one of your IRA accounts, filing joint, you or your spouse. You can't take the loss in the taxable account. There's no way to record it in the IRA account. Flip side of that, you take a loss in the IRA account. You buy it back in your taxable account. There's no problem there. If you initiate a loss in your IRA account, that's not a wash sale loss. That's fine. No worries on that. It's only a wash sale loss when you take it in the taxable account. James H. Got it. Thank you, James. Ben M. What is TTS Trader? Trader tax status. By default, people are investors. They get no investment expense deductions suspended under the new tax law. They can't elect 475 mark-to-market accounting tax loss insurance. They can't get the QBI deduction. They can't deduct health insurance. They can't deduct a retirement plan. They're just an investor. Most of America are just investors. But if they qualify for trader tax status, a term that we coined years ago, the IRS calls it trader in securities, trader in commodities, which is really 1256 contracts. So you need volume, frequency, holding period, hours per day, intention, a whole bunch of factors. Come to our website, click on, let me just quickly show you this here. You go to our tax center, scroll down to trader tax status, scroll on the right side, how to qualify, go through all of that, look at some blog posts, and then get the guide. That's how you work. You always go to our Trader Tax Center, the guide, and then consider a consultation. Let me open up the questions again here. Okay. TJP. What's the difference between an LLC and an S-Corp? I'm glad you asked that question, TJ. There's no such thing as an S-Corp entity under state law. You don't form an S-Corp. You form either a corporation or you form a limited liability company, or you don't form anything at all with the state. You just set up a spousal general partnership that files a partnership return. Now, taxes are something different. Let's say you set up a spousal LLC. Well, the default tax treatment would be partnership. Or if you set up a single member LLC, the default tax treatment would be a disregarded entity. You'd be back to filing as a sole proprietor on a Schedule C. Now, LLCs have the option to elect other tax treatments. So either the spousal member LLC or the single member LLC could elect S corporation tax treatment within 75 days of inception. Or the LLC could elect to be taxed as a C Corp, which would be a big mistake for almost all types of trading companies, unless you're very high income in a tax-free state for the C-Corp, and it's still probably a mistake. So you form the LLC, but then you elect the S-Corp status. May W. What is the latest tax law update on interest expense limitations as it relates to securities? Investment interest expense was not changed or repealed by TCJA, the new tax law. The existing rules apply. It's limited to investment income. So if you have a margin interest of $10,000 and you lost money trading, have no dividends, no interest income, no investment income, you don't get an itemized deduction. You carry it over to next year. If your married standard deduction is $24,000 for 2018, and your interest expense, which is allowed because you have investment income, is $5,000, and your SALT, state and local tax, is $10,000, you're better off using a standard deduction, so you're not really getting the benefit of the investment interest. If you're a TTS, trader tax status trader, it's not investment interest. It could be business interest. Maybe you use portfolio margining to leverage your investment positions, but then you use that margin for trading capital, for trading options. So it's very tricky. Is it business interest? Is it investment interest? Where do you put it on your tax return? If you have a spousal LLC partnership or spousal LLC S-Corp and your spouse is non-active, they have investment interest expense for their portion. You have business interest for your portion. The non-active spouse gets all the other business expense benefits, gets the 475 benefit. The one thing they don't get is they get hit with the investment interest expense. So we got to sort that out. TJP, again, is a single entity LLC worthless. No, it makes the S-Corp election. If you're single and not married, you can't have a partnership. You don't want to just come up with a partner. You have a single member LLC with the S-Corp election. If it's disregarded, you're back to trading like a sole, you're back to being a sole proprietor. It's not worthless. It's just that you're not achieving the health insurance and the retirement plan deduction and some of the other benefits of the S-Corp. Daniel L. I have an SMLLC. I've been day trading for a couple of months and have some losses for the year. Does it make sense for me to opt for 475 for next year? Well, if you have a large capital loss carryover to next year, then in Q1 next year, you may want capital gains to soak it up, and then you want a new entity with a clean slate to get into 475. So you got to think it out. Get my guide, read chapter 2 on all that MTM decision making. A lot of people have multiple questions. You can have multiple LLCs, TJ. Marvin R. I formed an S-Corp in March 2018, and I have losses trading 1256 contracts. 60-40 treatment, but it still is a capital loss. If I elect 475 ordinary losses, well, it's too late. If you formed your LLC in March 2018, you had 75 days from inception to file an internal in your own books and records using the honor system. So based on the premise of your question, it sounds like you didn't make that election, so it's too late now. So it's a little tricky. I'm not sure of the rest of your question, Marvin, but you may want to follow up with us. So for electing it for next year, again, so here's what happens. You have a 1256 loss in 2018. You have the option of doing a 1256 loss carryback election to carry it back 3 years, but only against 1256 gains, which you happen to have in those prior 3 years, I'm saying for argument's sake. That would get rid of the 1256 loss carryover from 2018 to 2019, give you a clean slate, but you don't want to elect 475 on 1256 in 2019 because you would rather retain the lower 60-40 tax rates. So this 475, all this stuff is complicated, folks. Don't just put your head in the sand. Sort it out properly. Your local accountant, it may be over their head. So I'm available to help you. James, in a paid consultation, James V. It's a shame to have to battle the IRS on all this stuff. Absolutely. I don't want the wash sales. By the way, 475 is your ticket out of wash sales, your ticket out of the capital loss limitation. If you don't want to deal with all this, 475 could be the answer. But otherwise, it's still complicated. I'm with you. The new tax law didn't really do anything to simplify all this stuff for investors and traders. That postcard tax return, that's a come on. They just made all these attaching worksheets. The QBI deduction is all new. The excess business loss, all new. Extremely complicated. Where was the simplification? And a lot more disenfranchising. I don't like that. Of losses and expenses. I think that's wrong to disenfranchise taxpayers from that. But that was a little editorializing. Craig N. If I have enough trades to qualify for TTS, but trade Forex has 1256 gains, that means Forex, you made the capital gains election, you trade majors, you don't take delivery, you had to work your way into 1256. Will that salary qualify for earned income? Yes, you can do the TTS S-Corp with or without 475, and anything that you trade with success, you can do the salary for the health insurance and the retirement plan deduction. Joe E. He's going to take a look. Good. Sean M. Does a trading strategy of selling a long at a loss, buying back? All right, this will get a little confusing. I can't answer this. Think out very carefully the puts, the calls, the stock, the assignments, the wash sale loss rules, the special rules for shorts, the special rules for assignments of options. It can get very tricky. Do it with the trade log software and then figure out what works and what doesn't. I don't want to try to get into that tongue twister right now under pressure on the call, Sean, so come back to us on that. If you have a real tricky situation, we can always feed it into our tax attorney to give you an answer, or one of our CPAs to give you an answer. And it can have huge consequences, and you should do it. It's worth the price. Period. For a solo person, I guess you mean a single person, no spouse, yeah, you want to go with the SMLC S-Corp. Now, if you don't need the health insurance and retirement plan deductions, but you benefit from the entity, then maybe the spousal LLC partnership or the spousal general partnership can work for you. But usually it's the S-Corp that you want, and that can go with a single or spousal. Jack L. How to deal with dividend interest well, dividend interest is Schedule B. It's not really part of TTS income per se, although if you had a strategy that involved dividend stripping and all that, and you wanted to look to income for purposes of doing compensation, we would allow that for a higher retirement plan contribution. What is the maximum dollars for converting IRA to Roth? There is no income limit. They got rid of that with the Bush tax cuts when Obama did the fiscal cliff. There is no income limit. Anyone can do the Roth conversion. It's a great backdoor way into a Roth. And the other great backdoor way is there's no income limit on the Roth contributions. Whether you can make $1 million and do the $56,000 or $62,000 next year in 2019 into the Roth solo 401k. No income limit. The income limit applies on a Roth IRA contribution. For the working man, John G. Depreciation can be used, but it does not provide a benefit because the IRA is tax-free. I'm not sure what you mean by that. Sean M. Any insight on how to deduct your trading expenses when you don't qualify for TTS? You're stuck. There is no more 2% AGI limitation. The new tax law flat out suspended investment fees and expenses, home office, education, computers, travel, seminars, mentors, dues, publications, data. If you don't have trader tax status, it's completely suspended on Schedule A. They did beef up the standard deduction, but you lose your investment expenses. Now, if you're a short seller, You still have your borrow fees as a deduction because that was not suspended. That remained as a other miscellaneous deduction. What they suspended were miscellaneous itemized deductions subject to the 2% floor. That's different. The other thing that remained is the investment interest expense. Bottom line, trader tax status is more important than ever before for you, for your hedge fund. David H., what entity will allow 1256 treatment? Every entity, every pass-through entity. The C-Corp won't, but every pass-through entity passes through 1256 to your individual return where you get the lower 60/40 rates. A wonderful tax benefit. Vic S., I elected 475 last year and qualify for TTS this year. Good. So you got to use the 475. Been day trading in 018. What is the process for filing the TTS? You're going to add a Schedule C to your tax return as a sole proprietor. If you elected 475 by April 15th, 2018, actually the deadline was the 17th, or because of the holiday. So you have to do the second step. Don't forget to file your 2018 Form 3115 by the due date of your 2018 tax return. That could otherwise jeopardize your use of 475. That's all covered in our guide. We prepare that form as part of our tax compliance service. Joe E., if I elect to utilize your service to form the SMLLC, thank you, you're welcome to do that. What accounting provisions would be used? Well, part of our entity formation service is to decide on whether you're going to elect 475 or not. And it's not a complete decision. We lay out what may involve Q1 2019 things that happened before the deadline. We set you up with the election, but then you get back to us before the deadline. It's not a service that starts and stops on day one. It continues into next year to cover the planning opportunities. So we cover it all. Read about the entity formation service on our website. You have to start with a consultation because I talk a lot of people out of the entity. They don't qualify for TTS. And then if the entity is right, then you upgrade for the entity and then we execute it all. It works great. I do all of that. I don't do the tax compliance service. I do the consults and the entities and the content. And I'm doing that all day, every day. And we set up the entities in all the states and we know all the state issues. And we go over all that in the consultation. Dennis, and I have plenty, I've opened up my calendar, I have plenty of appointments available through year end. This is, time for us to work. This is when we sell the Christmas trees, folks. I mean, this is, it's important to do the year-end planning. We all make sure that we're available to our clients before year-end to help them. But don't contact us over the holidays and expect a meeting on a holiday. Try to get it done now, this week, next week, the week after. Holidays are coming up fast. Dennis M. Question, large W-2 income, one of money's 401k. Well, there are income limits, but if you're inside of your entity, the S-Corp can do up to those maximums. So yeah, here's the nice thing. You got job income. You're paying the maximum FICA in your job. The only additional effective payroll tax you're going to have is Medicare. You got that Medicare anyway on your unearned income under the Affordable Care Act. So you have a big job. You're basically at the maximum FICA and Medicare. So you may as well do the Roth because you don't really worry about the payroll tax. You don't mind sacrificing the income tax deduction. And then you get the permanent tax savings for life. So you got the 401k, elective deferral in your job. You got the maximum FICA. We do the Roth profit sharing plan 37K for the next 5 or 10 years as a trader. And think about how that will grow until your retirement, tax-free for life. Okay, Dennis M. We'll be trading algos. Now, if you create the algos, you create the automated system for entry, exit, and execution, you get credit for the volume and frequency. If you use a third-party system and you don't get credit for the TTS. We've covered that in other webinars. Harry W. And Cynthia, tell me when we need to do a hard break. We're at 1:15 now. I'm still going strong on the questions, but you jump in on the hard break. I think I can knock off the rest of these in 10 minutes. Harry W. Are there comparable TTS statuses in Canada? I'm not sure about that. We don't do Canadian taxes. We help a lot of Canadians on the U.S. taxes, but I don't know the Canadian taxes, and we don't give advice in other countries. We do help non-residents, so we had content on that. Why would a single member LLC be disregarded? That's what it is with the IRS, Jeffrey P. It's a disregarded entity, a tax nothing, so it needs to make the S-Corp election. Scott I. A revocable trust is sort of disregarded too. It's part of your individual tax return, so you didn't really accomplish that separate return. Scott I. Can you have a non-active, non-spouse partner? No. This entity for your retail trading business is not for investors. You are very welcome to consider an investment management business, to have an LLC, S-Corp as your management company, and then have a Delaware limited partnership for investors. You should work with a securities attorney, go through all the securities law, licensing, registration with states as a registered investment advisor, with the NFA as a CTA, or maybe you'll be exempt. There are de minimis rules. I don't want people to just willy-nilly go, take outside investors into your entity, because then it's investment management. You can do it, but it's a whole different ball game. And I cover some of the tax issues in our guide and in our content on the website for investment management. We cover that. But that's a little bit different than what we're talking about today with a retail trading business for you and or your spouse. Gregory D. Did the IRS change any of the criteria needed to meet TTS? No, they did not. TCJA did not address that. There haven't been any new court cases this past year. We have not changed our guidelines on that. May W. Did the one second. Can you comment on 263A interest expense limitation? No, I mean, carrying charges, some of that's beyond the scope of today. Business interest did change with TCJA, but that's for big companies. It doesn't affect our traders. Hedging rules are beyond the scope of today's content, May W's. You may want to speak to our tax attorney on that. TJP. How does working for a prop trading firm fit into tax planning? Well, some prop trading firms want you to have an SMLC. You may want to stay disregarded, or you may want to be an S-Corp. It may help with the reduction of payroll taxes if you're an independent contractor. Prop trading firms, if you're an LLC member, you may get a share of the 475. So we cover all that in our guide. I don't want to get too much into prop trading today. Harold S. LLC, non-S-Corp, can you have health insurance, 401k? No, because you need the S-Corp to create the earned income. We're coming to an end here, folks. Robert G. I'm not sure what your question was. I see a lot of multiple questions from people. So I think we got to pretty much everything here, folks. One last question. Can you form a single entity? If you're married, yes, you can have a single member LLC. You can add your spouse on 1-1 or not at all. It depends if you're in a community property state or not, using community property money or not. I cover all that in the entity formation. So I think I got to all the answers to all the questions. So come over to the website, look around the tax center, and click on the contact us form to send us some emails, or you can also give us a call. If we don't answer the phone, it's because we're probably on with someone else. So be patient. We prefer the emails, but we do phone and chat too. So it's glad you came today. I know it was a busy day for some with President Bush in the morning. I'm glad you came. We will have the recording. We're standing by to help you with the year-end planning. So you would come to services, click on consulting, read about how it works. Buy now, and then purchase the 45-minute consultation with me. It's a little slow right now what we're doing. And then after that, you can click on the entity formation service and read about how that works and what's included. So thank you all. Thank you, Cynthia at IB, and back to you.
Okay. Well, Robert, thank you so much especially for being so generous with your time and all of those answers here today. But that is going to conclude our session. Also want to thank all of you for sticking with us this long. I know Robert has covered an awful lot of information with us here today, and do want to remind you that we have been recording today's session, and each of you will get a direct link to today's recorded playback, as well as a copy of the webinar slides that Robert's been using today. We'll be sending those out just as soon as I get them compiled and uploaded to our server. Also want to mention, Robert has been a regular presenter through this past year and even further back than that, and has a wealth of information that's already listed on the Interactive Broker website, some of which he's alluded to during today's event. You can access all of that previous information by going to the education menu on the Interactive Broker site. Into the webinar section, you'll find recordings button, and then you can filter by Robert Greene, and you'll find a wealth of information there. So with that, we are going to conclude our event today. Once again, thanks very much, Robert, for a great presentation. And that is going to conclude our session. You can all exit using the X in the upper right-hand corner of the screen. Also, keep an eye on your inbox for today's recorded playback. Thanks, everyone, and have a great rest of your day.